Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel dedicated to the rational, cash flow hungry investor who looks at critical thinking to come up with the value of a stock, then looks into the public market to see what you can buy it at. And if there's a disconnect, that disconnect is our economic return. Here we go. This week, Alphabet. They just recently released a quarter, absolutely crushed the number. We're going to look at 9 years of historical financial information and figure out what we think it's worth. Let's get to work. Behind me is the 10K of last year, fiscal 2020. Before we dive into this, let's review the 5 key attributes for all investing. Number 1, top line revenue growth. We've got to have it. Number 2, earnings growth. Ebitda is what we use. You've got to be growing. Number 3, strong free cash flow. Number 4, low debt. Lastly, we want a stock that's well priced. Well priced being enterprise value to Ebitda. All right, let's get into Google's financials. Behind me is 9 years of historical financials by year. These are USD per $1 million at the end of the fiscal year, December 31st. What you're going to see here is 2012, $46 billion of revenue, grows steadily every single year. Last full fiscal year, 2020, as of December, $182 billion of revenue. Congratulations. Man, I love that number. That is a huge, huge number. Fantastic. The most recent quarter, even that came out, was an excellent one as well, but we're just doing annual reviews. So as of December of 2020, there's the big juicy number. Fantastic. Every single year, top line revenue growth, 20% annualized. Definitely checks our box. Good job, Alphabet. Ebitda is our measure for operating income, operating cash flow. It's a proxy for cash flow. Not great. It has its flaws, I grant you, but it's a quick smell check that we can use to compare one company to the next. Ebitda, $16 billion to $55 billion of jack the last fiscal year. Outstanding. Woo! That is fantastic. I love seeing that money. Went from 16, 19, 21, 24, 29, 35, 41, 48, 55. Fantastic. Every year it's growing. 16% annualized growth rate. What a company. All right. Definitely checks the box there. Let's look for debt. Short-term and long-term debt goes from $3 billion to $28 billion. Not a big deal given the Ebitda growth that they've had. Let's look at market cap and enterprise value. FYI, I've zeroed these out because they did that share split, GOOG and GOOGL. Makes it a little difficult going back historically, so I'm just showing more recent data. Market cap, $354 billion, up to $1.2 trillion of market cap. What I like is the cash that they have. So they make so much money, it piles up on the balance sheet. And you can see this last fiscal year, $110 billion of jack sitting in the checking account. Whew. Man, that is so much money. It's inconceivable how big it is. $333 billion all the way up to $110 billion of actual cash on the balance sheet. Amazing. Clearly, the free cash here dwarfs any debt they have. So our debt measure is going to be zero because they have so much cash they could easily pay off all debt. We love to see that as a protection for us who buy equity. Market cap, as I said earlier, $1.2 billion. Enterprise value being debt, less cash, plus market cap is the enterprise. Enterprise value is the entire value of everything. Think of a piece of real estate. You buy a house. The market price you pay for that house is the enterprise value of the house. You then go to a bank and get debt, and you put debt on it to be able to afford it because you come up with your equity piece, which is less than the market value. Same thing here. Google has an enterprise value, but it's got some debt on it. So in this case, the cash is actually so large, but in general, you subtract the debt from the enterprise to get market cap. Here, this cash is so big, this is actually a negative number, and the enterprise value is less than market cap. Just a little trick in the math, but their value, $1.1 billion. On Ebitda, enterprise value, that is our relative value metric. That's number of years of payback of operating profit that you're buying it at. So here, you bought the company back in the day, $311 billion. You would have paid 14 times Ebitda for that company, so a 14-year payback. That market multiple has expanded over the time to now 28 times, which is a premium, I would say. Certainly given its history, you could have picked this company up much cheaper than you can right now, being at 28 times with its current price and current enterprise value of $1.6 billion. Let's take a look at free cash flow. My favorite statement, your favorite statement, free cash flow. 2012, $16.6 billion of cash flow from operations. That has grown to $65 billion of cash flow from operations in 2020. That's a 19% growth rate. That growth rate lines up with the growth rate of Ebitda. So the good people at Google's accounting department are doing their work. I love to see that, expensing costs as they should. Cash is mirroring the P&L. Great job, guys. CapEx, they are investing heavily in the future. I think that's because growth might be slowing a little bit more recently. You can see the percentage here, 22 into 66 versus 3 into 16. So they're having to invest more money into infrastructure, into the growth to maintain, because it's getting harder for them to grow the bigger they get. But still plenty of cash flow here. I like that number. Debt payment. This is the inflow and outflow of principal, not interest, principal payment. Here they paid down some debt. Looks like they borrowed a nice big $10 billion number in fiscal 2020. Free cash flow to the equity holder, right? This is the sum of these three. This is what Google is based on. When you buy any business, you're buying it for cash flow, and this is the free cash flow to the equity owner of Google. And last fiscal year, it was $52 billion of jack that they could distribute, they could use to buy back shares, they could do whatever they wanted with, because they already covered their growth CapEx here, and it just sits on the bank. Amazing, amazing. Now, I will say that this $10 billion does pump this up a little bit. So in my forecasting, to be extra conservative, I'm going to take this down and say it's zero. And I'll take $10 billion out of this number for forecasting for, because they can't do, well, they probably could, because they have so much debt, so much cash and so little debt. They probably could borrow that money. But I like being conservative, so I'm not going to give them credit for this free cash flow. I'm just going to take it out. But let's keep going. Shares outstanding. Here, shares outstanding have been growing a little bit, mainly because of just the issuance of natural employee stock. But more recently, they started buying back stock, which is what we want to see. Remember, one of the things we look for is what I like to call the trifecta, and that is strong earnings growth and cash flow, so the business is growing. You're buying back shares with free cash flow, so this number is going down, which it is right here. And last is the market multiple expansion. That's that Ebitda number over here, going from 20, for example, to 28. So if you bought this stock back when I first reviewed it last year, you bought it at 20 times enterprise value. That has then expanded to now 28 times. So every dollar of cash flow that you bought back in the day, now you're getting 28 times the same free cash flow. So that has grown. Plus, the share count has decreased since I last reviewed it, right? From 690 million shares to 676 million shares. And you have free cash flow. If you look at it, the price per share is up $1,000 a share since I last reviewed this thing. And you would have made a lot, or did make a lot of money had you bought it last time. We'll see what it's doing now, see what the price is, but that's what the trifecta means. They're buying back shares, they're generating cash, and you buy it at a low multiple to get the multiple expansion. Those three things stack on each other and you get compounded exponential growth, which we saw over the last 12 months by buying this stock. Okay, where did I leave off? Free cash flow per share, share price, yield, and ROIC. That's pretty strong and consistent for them. All right. Let's see, what do we want to do? Let's forecast this business. So far, top line revenue growth, amazing. Ebitda, free cash flow, great. Low debt, fantastic. Let's forecast it. Come up with a price target that we think this stock is worth 10 years from now. Then we'll look into the public market, what we can buy it for, and what that return is. We're going to do this by first looking at our Ebitda numbers. So this is $62 billion, which is me taking last year's Ebitda at 2020, growing it at 14%. 14% is what they grew last year. It's down from historical was 16%. It's down a little bit as they get bigger. But I stretch it out and I break it down over time because they'll get bigger and the future's less well known. So I'm not going to hold 14% constant. I'm going to bring it down to be conservative. So I go from $62 billion to $135 billion of Ebitda in 2030. I give it a 20x handle, which is less than it's currently trading at. Remember, it's currently trading at 28 times. I'm bringing that back down to an average. That market multiple decline is going to weigh on our return a little bit. I would have liked to have bought it here or anything here and gotten that expansion. This is kind of the reverse of that. But long term, to be fair, to not overpay for something, I put a fair multiple in. $2.7 trillion enterprise value, plus debt less cash, $3 trillion market cap company in 2030. Divide by the shares outstanding gives me $4,439 share price out in 2030. That's our future price estimate for Google based on an Ebitda market multiple method. Let's take a look at the free cash flow method forecast. My free cash flow to equity per share estimate next year is $72.25. How did I get there? A little reminder, last year they had the $9 billion of debt. I've removed that and just took CFO minus CapEx, that sum divided by the shares outstanding, and I grew it at 14%, gives me this number. I then follow the same Ebitda growth rate because Ebitda and free cash flow are growing similarly, and I get long-term value of $156 of free cash flow per share. I give that a 2.5% yield, which is similar to what we've been saying, a little smaller, and I get a $6,260 price target out in the future. Okay, now we have two price estimates for what we believe Google is worth out a decade. Let's average them and look at the current price. Now I can buy the stock currently at $2,400 a share, $2,400 a share. I've got our price estimates here under two different valuation methods. A free cash flow method produces about $6,200 and an Ebitda market multiple method of $4,400. I'm going to split the difference and call it $5,300 as a price target out a decade. But I can buy that right now for $2,400. When I put this into an IRR calculation, I buy one share company. This is the fractional ownership of the free cash flow that I have a percent ownership in, that I have a claim in, and then I sell this business in 10 years for my future value. This is the cash flow that the business generates. Whether I get to keep it or they buy back shares or they piles in the balance sheet, it doesn't matter. It's still mine. In the end, that gives me a 13% IRR or roughly 2.7, call it 3 times cash on cash return over that period of time. This is an above market estimate of return, especially in this elevated market that we're currently experiencing. I don't think this stock is out of price. I think it's a good value stock. I would continue to buy that just like I liked buying it last year, and now we're up $1,000 per share. Amazing. Kudos for you who follow the channel and bought that stock. So I'm definitely going to give it a good, still like the stock, fantastic cash generation. Let's recap our 5 key attributes, right? The top line revenue growth, solid. 2 is earnings growth, definitely growing. Strong free cash flow, yes. Low debt, it's 0, fantastic. And well priced, yes, it's still well priced. So I like, it meets all 5 key attributes. I like the stock a lot. If I put this into a distribution path, right? Currently $2,400 a share. I'm getting 13% annualized IRR by buying the stock, which is above market, 10% being the S&P 500. So I think it's going to outperform. As it goes up, you're paying a premium, and I think it's going to underperform as it goes up. So I'd be careful. But for some reason, if it should fall, it's a huge buy in my opinion. This is one of those stocks that you put on your shelf, and if the world melts down and everyone's freaking out, you pick this one up and say, what's the current share price? Oh, it's $2,000, I'm in. You know, that's one of the kind of things you keep in the back of the mind. You keep on the shelf a board that says you would buy these stocks at these prices if something happened, and you go right to them. I find it saves time for me if I know what I'm willing to pay for a stock. The market kind of whipsaws a little bit. Sometimes you get lucky and get the price target that you want. So 13% at a $2,400 price target. This has been rational investing. This is Google or Alphabet. My name is Cameron Stewart, CFA. Thanks very much for watching. Hit the subscribe button, like. If you like this analysis, you want to learn how to do it yourself, there are thousands of securities out there. I can't possibly cover all of them, but I can teach you to do it yourself. Check out my cash flow investing course in the description below. I give you this template. I walk you through Apple Corporation, how to value it, so you can go out and value any stock that you want, put it in the template, make a few adjustments, and you'll get this case that you're looking for, and it'll help you out. Thank you very much. Really appreciate the support. Thank you. Bye-bye.